Banco Ambrosiano, Italy. Founded in 1896, Banco Ambrosiano grew into one of Italy's most influential private banks. But by the early 1980s, this powerhouse would crumble in one of Europe's most scandalous financial collapses. The downfall began with a massive scandal. Over $1.3 billion went unaccounted for in 1982, triggering panic and a breakdown in trust. Clients rushed to pull their money, only to find the institution in chaos. It wasn't just bad accounting. Behind the scenes were secret offshore companies, illegal loans, and powerful ties to the Vatican Bank and even the Italian mafia. The bank's chairman, Roberto Calvi, nicknamed God's Banker for his Vatican connections, became a central figure in the mystery. Days after the collapse, Calvi was found dead, hanging under London's Blackfriars Bridge. Though initially ruled a suicide, many believe he was murdered to keep secrets buried. Investigations revealed a complex web of fraud, including loans made to shell companies in Latin America and deals used to secretly move money out of Italy. Several officials were arrested, and the scandal damaged the reputation of Italy's entire banking system. Banco Ambrosiano's fall wasn't just about money, it exposed how corruption, religion, and organized crime had become dangerously tangled inside a financial institution. It remains one of Europe's most infamous and mysterious bank failures. Washington Mutual, USA. Founded in 1889, Washington Mutual, known as WAMU, grew to become the sixth largest bank in the United States by the early 2000s. But when the 2008 financial crisis hit, WAMU collapsed almost overnight. With over $307 billion in assets, it became the largest bank failure in American history. The root cause? Excessive exposure to subprime mortgages, risky home loans given to borrowers with poor credit. As defaults surged and home prices tanked, WAMU's balance sheet crumbled. Then came the panic. In just 10 days, depositors pulled out nearly $17 billion. Fearing a full-blown run, the FDIC stepped in and seized the bank, selling its assets to JP Morgan Chase for $1.9 billion. WAMU's swift downfall wasn't just about bad loans, it was about lost trust. When customers rushed to withdraw their money, the bank simply couldn't keep up. Lesson learned, even massive banks can crumble in a matter of days when confidence disappears and the books are built on sand. Herstatt Bank, Germany. Founded in 1955 in Cologne, Herstatt Bank was a small German lender that became infamous for a collapse that shook the global banking system. In 1974, Herstatt made highly leveraged bets in the foreign exchange market, expecting the US dollar to fall. But when the dollar strengthened instead, the bank was left with devastating losses it couldn't cover. German regulators revoked its license on June 26, 1974. The fallout didn't stop there. Because of time zone differences, Herstatt had already received payments from European counterparties that morning, but hadn't yet sent matching dollar payments to US banks via its New York branch. When regulators shut the bank down before US markets opened, those outgoing dollar transfers were frozen mid-process. This mismatch between incoming and outgoing legs of a transaction caused widespread disruption and led to what's now known as Herstatt risk. The risk that a party in a cross-border trade could default after receiving funds but before delivering theirs. Herstatt's failure remains one of the most influential lessons in settlement risk, prompting global reforms in payment systems and time zone coordination. Silicon Valley Bank, USA. Founded in 1983, Silicon Valley Bank became a key lender to startups and tech companies in the US. Silicon Valley Bank, SVB, collapsed in March 2023, becoming the second largest bank failure in US history and the biggest since 2008. With around $209 billion in assets, it wasn't a household name for most people, but it played a critical role in the startup world. SVB primarily served tech startups, venture capital firms, and other fast-growing companies. It took in deposits and provided loans tailored to the unique needs of the startup ecosystem. But unlike traditional banks with a broad client base, SVB had a highly concentrated group of clients, many of whom held large deposits well above the amount typically protected by deposit insurance. When the bank began facing losses on long-term bond investments made during an era of low interest rates, panic spread quickly. On March 9, 2023, worried customers rushed to withdraw funds, triggering a classic bank run. SVB simply didn't have enough cash on hand to meet the demand, and regulators stepped in the next day to shut it down. Its failure sent shockwaves across global markets, especially in the tech and venture capital sectors. SVB's failure was a reminder that even modern, innovation-focused banks can fall fast, especially when confidence disappears. Crédit Lyonnais, France. Lyonnais was founded in 1863 and became one of the most prominent state-owned banks in France. Crédit Lyonnais was once one of France's largest state-owned banks, but by the mid-1990s, it had become the center of one of Europe's most expensive banking failures. The trouble began when the bank aggressively expanded its lending and investment activities during the late 1980s and early 1990s. It financed everything from Hollywood film deals to risky real estate projects. Over time, huge amounts of bad loans piled up on its books, and internal controls were weak. By the time the full extent of the damage became clear, Crédit Lyonnais needed a government rescue of over $20 billion. The scandal involved fraud, mismanagement, and questionable political connections. It also led to multiple criminal investigations and public outrage across France. The bank's collapse wasn't just a French problem, it became a major moment in EU financial history. It raised serious questions about how state-owned banks were managed and regulated, especially when public money was used to cover massive losses. Eventually, the bank was restructured and absorbed into what is now Crédit Agricole. But the legacy of Crédit Lyonnais lives on as a cautionary tale about unchecked expansion, poor oversight, and the risks of political influence in banking. IndyMac Bank, USA. Founded in 1985, IndyMac Bank grew into one of the largest savings and loan associations in the U.S., with a focus on real estate lending. Headquartered in Pasadena, California, it became a major mortgage lender during the U.S. housing boom. IndyMac failed in July 2008, just months before the global financial crisis reached its peak. The bank was heavily involved in real estate loans that were easier to qualify for, but lacked some of the documentation or controls typical of traditional mortgages. When the housing market began to decline, IndyMac's loan portfolio rapidly lost value. Public concern escalated, and in a matter of days, the bank saw massive withdrawals. A classic bank run unfolded, leaving the bank unable to meet obligations. The FDIC stepped in, and IndyMac became one of the largest U.S. banks to fail up to that point. Its failure became a cautionary example of how aggressive mortgage lending and public panic can quickly turn into a financial disaster. Barings Bank, UK. Founded in 1762, Barings Bank was Britain's oldest merchant bank and one of its most respected financial institutions for over 2 centuries. But in 1995, the bank collapsed entirely due to the unauthorized actions of a single employee, Nick Leeson, a derivatives trader working in Singapore. Leeson had been making unauthorized speculative trades in the Japanese stock market. When those bets started losing money, instead of reporting the losses, he hid them in secret accounts. Over time, the losses spiraled out of control, eventually reaching £827 million. What's remarkable is that Barings had no effective oversight in place. No one questioned how a junior trader was generating seemingly endless profits. By the time the fraud was discovered, it was too late. The bank was insolvent. The collapse of Barings became a wake-up call across global finance, exposing just how dangerous weak internal controls can be. Even the most historic institutions can fall when risk goes unchecked and no one is watching. Lehman Brothers, USA. Founded in 1850, Lehman Brothers was one of Wall Street's most iconic investment banks. At its peak, it was the 4th largest U.S. investment bank, with over $600 billion in assets. But in 2008, it became the most high-profile casualty of the global financial crisis. The core issue? Lehman had massive exposure to subprime mortgages, high-risk home loans given to borrowers with poor credit, and mortgage-backed securities, which are bundles of those home loans sold as investments. As housing prices began to collapse and mortgage defaults surged, the value of those assets plummeted. Lehman tried to raise capital and sell off bad assets, but confidence in the firm eroded quickly. In the days leading up to the collapse, Lehman looked for a buyer or a government rescue. But unlike other struggling firms, the U.S. government refused to bail it out, a decision that sent shockwaves through the financial world. On September 15, 2008, Lehman went under, triggering a wave of panic in global markets. Banks stopped lending to each other, stocks plunged, and the modern financial system teetered on the edge. Lehman's fall wasn't just a failure, it was the spark that turned a housing crisis into a global financial meltdown.